Many investors begin with a specific fantasy, finding one massive winner, putting everything behind it, and watching that single choice grow into a fortune. But in practice, markets are rarely that cooperative. A sudden earnings miss or a shift in the industry can erase years of progress in a single afternoon, creating a level of volatility that the human brain is simply not evolved to handle. This chart shows how a concentrated portfolio behaves during a downturn. When a line is shaking this violently, it triggers a literal fight or flight response in your nervous system, making it nearly impossible to think about long-term goals. This biological stress leads to the two most common errors in investing: panic selling at the absolute bottom to make the pain stop, and buying back in at the peak because of a fear of missing out. To survive the market's natural cycles, you need a system designed to maintain discipline when your instincts are screaming at you to do the opposite. That system is portfolio diversification, a structural defense that uses mathematics to insulate your wealth from the volatility that triggers emotional decision-making. The first step is asset allocation. Instead of a single category, you are dividing your capital across a mix of stocks, bonds, real estate, commodities, and cash, so no single asset class dictates your entire future. This works because of a concept called correlation. Correlation is the measure of how different investments move in relation to one another during a crisis. With high correlation, assets move in lockstep. Crashing simultaneously creates steep drops that force panic. However, low correlation ensures assets move independently. As one falls, another holds steady, smoothing the portfolio's overall path. Smoothing out this visual volatility effectively neutralizes the emotional triggers that lead to panic selling. You aren't seeing the deep dips, so you aren't feeling the urge to react. A strategy is only as good as its execution. A localized political shift or regional recession can still pull down the entire system at once. Geographic diversification solves this by spreading capital across North America, Europe, the Asia-Pacific, and emerging markets. This ensures that a crisis in one part of the world is balanced by growth in another. The same logic applies to the industries you own. Even in a strong economy, individual sectors can experience isolated bubbles and crashes that have nothing to do with the broader market. By diversifying across sectors, including technology, healthcare, finance, and energy, you remove your reliance on any one industry to carry the portfolio. Expanding the net globally and across industries means a disaster in one specific area remains a minor statistical blip, rather than an event that puts your life savings at risk. A strategy is only as good as its execution. Because human willpower is unreliable over decades, the most successful systems are those that function without requiring a daily decision. Dollar-cost averaging is the tool for this. By investing a set amount consistently every month, you ignore the noise of market timing and allow the math of long-term growth to do the work for you. As some investments grow faster than others, your original balance will naturally shift, making the portfolio more lopsided and risky than you intended. Automated rebalancing forces you to sell high and buy low, the very actions that greed and fear often prevent. The system automatically returns to center, keeping your risk levels exactly where they belong. These tools move investing away from a series of stressful, high-stakes decisions and into a predictable process that runs quietly in the background. Compare the constant anxiety of an investor watching a single stock to the quiet confidence of someone who trusts a diversified, automated system. Without a system, it is easy to fall into the common traps of overconcentration, emotional trading, or letting costs and a lack of rebalancing erode your gains. To defend against those traps, follow the 5 pillars. Diversify across assets, regions, and sectors, invest consistently, and rebalance regularly. Success relies on a system where diversification manages long-term risk, ensuring that returns depend on the architecture of the portfolio rather than the momentary impulses of the person holding it.